And we had the question before class started here a little bit about the homework. And because our game plan really is to get through chapter 9, hopefully tonight, that will leave chapter 10 undone. I'm going to record chapter 10. That recording will be up about the middle of next week, so that it is available as you're preparing for your exam. And then, as I mentioned, on Saturday, May 1st, from, what did we say? We would do it in the morning from, I guess, 9 to 1. We'd spend a 4-hour session doing the final review, which is optional. But observing that we're sort of crunching here towards the end, do your best to get through as many of the homeworks as you can. Meaning, if by the time you get to chapter 8, you're not quite finishing things up, I'll understand that, and I'm not going to penalize you for a few homeworks that you didn't get done, particularly towards the back. Please don't have me look at your homework and see that you did nothing. You need to have at least made some attempt to get in there and do that, particularly through those first 7 or so chapters, okay? But don't let me get in there and see nothing in there. Okay, you do have to have, done some of the homework. I can't give you a grade if you do nothing. And then for the guest speaker paper, that's due. Where's that assignment? No, it was here somewhere. I just was looking at it right here. Okay, the guest speaker assignment is right here. 6 of you have turned it in. Okay, that is due April 25th. That's Sunday. Okay, so you need to get those homework, as many as you can. Again, don't sit there showing me nothing done on the homework, the Becker software homework. And don't forget to turn in that paper, okay? You've had plenty of time now to have done that, so make sure you're turning that in by April 25th. I cannot extend the time, even though I'm going to be posting lectures past the end of the class and doing that final review on May 1st. I can't wait till then to go to grades. So don't mistake that for meaning, oh, okay, I have all the way to May 1st to turn things in, because they want me to turn in the grades next week. So I need that paper, and I need you to have made reasonable progress through the homework, good progress through about chapter 7. I'll understand if that starts to wane off chapter 8, 9, 10, and if you missed a few things in those earlier chapters, okay. If I look and I see that, you have completely blown that off, that's going to be a problem, okay? So if you, want to confess to me, hey, I decided to blow off the homework or something, you need to have that conversation with me. If I look in and I see nothing done there, I'm not going to be none too happy, and that's going to be reflected in your grade. Question? Okay. I've also been watching attendance, and so I've been making notes as that progresses. So if you have an attendance problem, you need to talk to me about that as well. I think I'm a pretty reasonable guy. I'm not here to mess up anybody's GPA. By the same token, I can't have someone not coming to class, not doing the homework, not turning in the paper and say, hey, give me an A or else. That's not going to happen. Okay. All right. Enough of all that, because we do have, some important stuff that we need to get through tonight, which is I really, really want to get through chapter 9 tonight, or at least feel like we got through a good chunk of chapter 9. Okay. So I'm going to go ahead and put us in tablet mode, get my machine, my beautiful screen here. Okay. And let's go ahead and talk about governmental. Okay. Now, as I've mentioned a couple of sessions ago for not-for-profit, you can expect a good 5, 6, 7 multiple choice questions, maybe even a task-based simulation on not-for-profit. Governmental is even more than that. Okay, governmental, you can very well expect 15 to 20. Of course, I got blue on blue. 15 to 20 multiple choice questions, and maybe even a task-based simulation on governmental. That's a lot, okay? And I make a big deal out of this because I hear a lot of students express dismay about the idea that there was so much governmental and not-for-profit on their exam. And I question, well, who have you been talking to? Who have you been listening to about governmental and not-for-profit on the exam? I even notice we get a few students towards the end of the class don't show up for these chapters, and that's a huge mistake for two reasons. One, obvious one, is the depth of coverage there, the breadth of coverage, 15 to 20 multiple choice questions. That alone will keep you from passing the FAR section of the exam. The other thing that's a shame, really, is that governmental not-for-profit, people fear it. But if you get candidates that are getting ready for the exam fear it, but if you really look at it and spend a little time with it, it's not that tough. It's not that tough. You just have to put in a little bit of time pushing, and then you all of a sudden, oh, I've got this. And now you've got something that's working very much in your favor, because the examiners are thinking, okay, people are afraid of this. They don't like it. They're not going to spend time with it. They're going to underestimate how many points we're going to put on it. And bang, here come a bunch of points on it. Now, some people will say, well, why do we even have to study this? Well, because there are multitudes of state and local governments that have to receive audits from private auditors. And for the 2024 version of the exam, they talked about getting rid of governmental, and the practitioners gave a resounding no to that proposal because they have many, many state and local government clients. So it is relevant, obviously, from the standpoint of points on the exam. If you get used to this stuff, it can be a set of easy points for you, relatively easy points. I mean, nothing's that easy on the CPA exam, but relatively easy points to the rest of the material on the exam. And third, it has a practical element. You could very well find yourself involved in an audit of a state and local government when you're working for one of the firms. Okay. Yeah. All right. So that's just the little introduction here, guys. The point value, I'm not going to try to parse out by points for these different areas, but really heavy is these sections here in chapter 9. All of this is heavy. And then there's some medium things that you'll see on the video dealing with our proprietary funds and our fiduciary funds are light. And then the government-wide stuff that we'll talk about in chapter 10 is fairly light. All of that, the material from chapter 10 and more heavily, the material here, okay, in this chapter are going to be part of those 15 to 20 multiple choice questions, 15 to 20 points essentially on the exam. Okay. Okay, guys, we don't do questions in chat. Okay, if you've got a question, please ask me the question. But I see that we are all the sections tested individually, or is it a mixed batch of questions, all sections at random? So I think what that means, will all the governmental questions be together in one big chunk? Is that what you're asking me? Okay.
Yes.
Huh?
Yes.
So you're saying, would they all be like 15, 20 in a row type of thing in multiple choice questions, like all of them?
Right, I mean, that versus, you know,
Yeah.
I mean, you said pensions probably are gonna fade away, but
Well,
change it.
okay, well, wait, let's clarify pensions. I'm not seeing the connection, but we'll get to it in a second. Pensions are going away entirely after July 1st. So if you're taking the exam July 1st or later, you will not be tested on pension. If you are taking the exam before July 1st, you can expect to see a spattering of maybe about 3 or 4 multiple choice questions. Okay, that's pensions. Government, 15 to 20 multiple choice questions. They would be dispersed amongst the, what do you have, like 64 or so multiple choice questions. So they wouldn't all be, so the answer to your question, they wouldn't all be like one together. That's not to say that, one after the other. That's not to say that you might not have a cluster of them all of a sudden that show up 3 or 4, but they're not going to be, 20 questions in a row of governmental. No. Does that answer your question? Does that answer your question? I can't see you tonight, guys.
That's got it, thank you.
Yeah, okay. Okay, great. I can't see you tonight. I don't have my second monitor, so I can't see you. That's been the case the last couple classes. So please just call out if you have a question, jump in and say something because I can't see you. Okay, all right, good. Let's go ahead then. If there's no questions on that point value other than pay attention to the governmental, right? I mean, I can't say that enough because the reason you're saying, why do you keep harping on that? Because I say it and then I get a student that says something like, well, John, you never told me there was governmental. And I'm like, I did. Veins popped out of my neck. I said governmental. You have to know about it. Okay. So make sure you're comfortable with this material. But as we'll see, it's not that hard once you kind of get used to some basic things. Okay. All right. So if there's no questions, let's go ahead. Let's jump in and we start talking about the objectives of fund accounting and reporting. Now it's interesting in that if you look at what the government accounting standards board, like the FASB, we have the Gasby. They in fact are related entities that share the same office space in Connecticut. You have the Gasby, you have the FASB. Gasby sets the accounting standards for state and local governments. And Gasby says that the primary users of government financial reports are the citizens. And I'm like, no, I don't think so. Okay. Like now they've given us a homework assignment just because we're citizens. Citizens don't really look at their state or their local government's financial reports. The entities that use those tend to be dealers in state and local bonds. Okay, so these reports are used, and they are audited, but they're not so much used by citizens. Okay, but when we look, regardless of who the users are, and we look at the objectives of these financial reports, notice that they're telling us that we're using fund accounting, and it enables governments, mission-driven organizations, to see that money is being spent in compliance with fund restrictions and spending limits. Okay, so let's just think about that for a second. Okay, when we look at fund restrictions, we're looking at, I'm just going to put down here, compliance with legal requirements. Compliance with legal requirements. Okay, when we look at this idea of budget, okay, then we're talking about budgetary control. Okay, so go ahead and flashcard that as objectives. budgetary control, compliance with legal requirements. Okay, but let's just, kind of get away from some of that jargon a little bit, and let's kind of speak English here a little bit. Okay, so let's go ahead and start by testing my artistic ability. What's that?
A street.
Good. See what an artistic genius I am? Okay. So that's a road. Good. And what happens? Let's say that our state legislature, whatever, decides that they're going to put a tax on gasoline, and they say that that gasoline tax is to be used to make road improvements in roads. So that's a dollar sign coming out of the gas tax and then being spent to improve roads, right? Okay, well, what's going to happen? They're going to say you have to spend that money on road improvement. And so we're going to be using these fund accountings that we're going to be talking about here to see that that money is spent for what? Not for building, city buildings or something like that. It's to be used for what? Road improvement. Okay. Now let's say the law says not only do you have to spend this gas tax money on road improvement, but you're limited to spending only $1 million a year. Well, if that's the case, then what? Maybe they don't want them to just go crazy in any one year where they get a lot of gas tax and blow the money unnecessarily. So they want them to stretch that over a period of time. Then we would set up a budget to achieve budgetary control. Okay, so we're going to be looking at fund accounting, and it so happens that this gas tax would likely fall under a category called a special revenue fund. The revenue is the gas tax. What makes it special? It's got to be spent on road improvement. And we'll be looking at the nature of funds that we will use to keep track of this various activity. Okay. Now I heard, and again, I need to quit that Facebook FAR group. Somebody on there advised, well, if you're going to be studying governmental, throw out everything you know about accounting. And I'm like, well, if you did that, you wouldn't understand anything about assets, liabilities, revenues, expenditures. You wouldn't know anything about debits or credits. What do they mean? Throw everything out you know about accounting. We're going to be taking our accounting knowledge is what we're going to be doing. And we're going to be using it to apply it to something that's a little bit different from what we've done with commercial. But once you get used to what you're supposed to do here, your accounting knowledge is going to allow you to be very successful in answering questions that deal with governmental accounting. Okay. All right, good. So let's go ahead and take a look. I'm not going to go through all that example of what I just talked to you about. And let's just take a look at the nature of governmental units that are on the CPA exam, okay? And the first thing I'm going to do, not because I'm mad at them, I'm going to cross out the federal government, okay? I'm not doing that because, I want to support anarchists or anything like that. I'm doing that because they don't test federal government accounting on the CPA exam. It is state and local government accounting. Federal government accounting is very specialized. It is used by federal agencies. There are a limited number of federal agencies in the United States. Most of that work is done inside the corridor in Washington, D.C., inside the Beltway, I should say, in Washington, D.C., and it's really not nearly as applicable to the rest of the country. So the examiners do not test federal government accounting standards set by the Federal Accounting Standards Advisory Board, the FASAB. They do not test those standards on the CPA exam. It is state and local government accounting. It is going to be mostly cities and counties. Sometimes they'll mention a state, but not very often, because we know that there's no such thing as a fake state. Cities, they can say the city of Porterville or something, and it doesn't have to be a real city. So it's cities. Sometimes you see them mention counties in questions. You'll never see the federal government. I doubt you'll see state government. Sometimes they'll say state does this and they don't say the state, okay, because we all know there's only 50 states. Most of the time, most of the questions are cities and counties. Now, we dealt with colleges and universities in F8, guys, so you don't have to worry about that here. In fact, I don't know why they mentioned it here other than to annoy me, okay? So we've already talked about that, okay? All right, good. So let's just calm down. And again, if you got a question, chime in. I cannot see you today, okay? You come over, and the entity that sets the standards for the state and local governments and is most authoritative is the Governmental Accounting Standards Board. I will be referring to that as the Gasby, okay, Gasby, okay? So you can flashcard that if you are, you know, sort of thinking that might be something you would forget. Go ahead and flashcard that. I mean, that's pretty straightforward. Governmental Accounting Standards Board sets accounting standards for state and local governments. Pretty easy to remember, okay? Now, when we look at the Gasby framework, okay, we're going to see that the areas where FASB really lays out most of its requirement is in Gasby 34. You do not need to remember you know, standards by number, but if you were ever going to remember standard by number, this is a good one. Gasby 34 sort of sets up the overall framework reporting that we're going to be talking about in the next couple of classes, okay? And it includes basic financial statements, and those basic financial statements will be both government-wide statements and fund financial statements. It also includes required supplemental information. Now that falls under the Gasby requirements. They mention comprehensive annual financial report, which we do get into in F10. That is information that is required by the Government Finance Officers Association, GFOA. It is an association of finance officers that work for the government, okay? Government Finance Officers Association, and they put out guidelines that many practitioners use. Probably the most important thing they do is they give an award in excellence in financial reporting if an entity prepares a comprehensive annual financial report in compliance with their guidelines. And what the GFOA requires is that we take what Gasby requires all primary state, local governments to prepare. It requires them to prepare that information, and they take that information and put it into the middle of the comprehensive annual financial report. So like many annual reports, it's not just limited to the financial statements. If you pick up the annual report of any entity, you see a lot of other stuff in there, an MD&A, other information that's not the basic financial statements in the notes there too. Gasby focuses on what are the financial reports, what is the financial reporting aspects that have to be provided. GFOA says, okay, Gasby just required you to prepare that. And if you want this award in reporting excellence, take that and put that into an annual report that meets these certain requirements, which we would get to in F10, okay? But tonight, F9, we're really focusing here. Part of F10, okay, we'll be focusing right here, and then we'll get into F10 a little bit, some of this stuff up here, okay? All right, so main takeaway right now, we're following standards of the Gasby. Okay, any question? All right, now they go on and talk about a bunch of different things there that, you know, I'm not going to spend a lot of time with, particularly because that is the most scary graphic I've ever seen. I think they wanted those mice to look cute, and they ended up scaring me. So they get a little granular up in there. I don't think you need to worry too much about all this stuff here. What I want to do is get us to our discussion where they start to talk about external reporting up here, okay? Now, this is a little annoying too, to be honest with you, because all we talk about in the FAR exam is external reporting. I mean, that's the whole subject. Financial accounting and reporting what has to be reported externally. So I don't know why they have to now all of a sudden call out external reporting. We haven't been dealing with any budgetary internal kind of stuff at this point in time. Okay, we're going to be talking about budgetary entries that governments provide. So maybe that's the reason they felt they should mention external reporting here. But most of our FAR exam is external reporting. Okay, but let's just go ahead and let's just take a minute to see what sort of the minimum reporting requirements are. Okay, so what Gasby reporting requirements say is if you are a state or local government, state of California, city of San Francisco, county of San Francisco, city of Hayward, okay, if you are a state or local government, not the federal government, then you have to provide certain information. You have to provide a management discussion and analysis, an MD&A, and they tell us that that is required supplemental information. Okay, required supplemental information, abbreviated RSI. They say that's required supplemental information. Then they tell us that you have to provide something called basic financial statements. And then they remind us, which we should know, that the notes to the basic financial statements are really part of the financial statements, right? Okay. Then they tell us that you have to provide RSI other than MD&A. And they tell us, they literally tell us, you have to provide the information in this order, 1, 2, 3. Okay. Now, if you look at what I've written here, assuming you can read that, everything here is what? Is either required supplemental information or what? The basic financial statements. Okay. So I ask you, what does the word required mean? It means you have to do it. It is required. You are required to turn in the guest speaker write-up, right, for this class, right? You are required to do your homework, whatever, okay? So required supplemental information means you have to provide it. You have to provide an MD&A, management discussion and analysis. Now, when a government provides a management discussion and analysis as part of this basic financial model, it's not talking about, you know, how many city lights shine at night. It's talking about what? It's talking about financial aspects of this government, okay? Then it does what? Then it says, well, here's the financial statements. And then they say required supplemental information other than the MD&A. So what happens? Everything up here is designed to supplement the financial statements. Now, when we get to the required supplemental information other than MD&A, that's things like budgetary comparison schedules, compare budget to actual, these sort of things. And we'll get more into this in F10. We'll get more into this in F10. We'll deal with the basic financial statements tonight and in F10. Okay, so let's go ahead and let's dive in a little bit deeper here. Okay, let's talk about, well, what goes into these basic financial statements. Okay, and you have 2 levels of reporting. You have 2 levels of reporting. You have government-wide reporting, okay, and government-wide I should just go ahead, FS is financial statements. And you have fund, not fun, but fund FS financial statements. Okay. All right. So let's go ahead and let's just take a look at the fund financial statements. And it turns out that there are 3 categories of funds. 3 categories of funds. We have governmental funds, and there are 5 of those. 1, 2, 3, 4, 5. There are 5 funds that we fit into the governmental fund category. There's 5 of those. I'll put a 5 there. Okay. Then we have a category called proprietary funds. Okay. And the proprietary funds, there are 2 of those. Put the number 2 there so you realize that this is showing you columns. This is not a graveyard. This is showing you columns of funds that are reported at the fund financial statement level. And then, so there's 2 categories, 2 levels. Level 1, level 2 is the fund financial statements. That's the 2 levels. Okay. And at the 2 levels, at the fund level, at the number 2 level here, we have 3 categories of funds, 5 governmental funds, 2 proprietary funds, and then we have a 3rd category called fiduciary funds. That says funds, fiduciary funds, and there are 4 of those. Now, I'm not going to call out the names now because we're going to get to the names of the funds and whatnot, but if you do the math on this, you've got what, 3 categories, 11 funds. And then what we do, okay, is we consolidate these funds and we report them at the government-wide level. Okay, so what we do is we take some of these funds, not all of them. I'm trying to make a circle around this, if it'll let me. It's one of those circles that keeps wanting to disappear. We take some of those funds, we consolidate them and report them at the government-wide level. So we consolidate those funds, and for the governmental funds and one of the proprietary funds, we put it under a category called government activities. Okay, government activities, that says government activities. And for the other proprietary fund, we take it and report it under something called business activities. I'm just going to put bus activities. Okay. Okay, so we do that and we consolidate. Okay, the fiduciary funds we don't consolidate up at the government-wide level. We're going to get to that much later, probably next time when we try to finish up chapter 10. Okay, but what happens? You take a look, and now this picture. Let's just take a look at the whole thing here. Okay, so what happens if you are any state or local government? Okay, any state, any local government like a county, city, etc., right? What happens? You are required by the Government Accounting Standards Board to prepare a management discussion and analysis. It's a written narrative just like any MD&A, but it's talking about financial aspects of this government. Then you are to provide the basic financial statements, and then you provide required supplemental information other than the MD&A. So notice both the MD&A and the required supplemental information other than MD&A are both required supplemental information. So you have to provide it, it's required. What does it supplement? It supplements the basic financial statements. So they're financial documents in nature. What are the basic financial statements? Well, there's 2 levels. There's the government-wide level and there's the fund level. The government-wide level is a consolidation of the fund level. The fund level is providing what? Additional detail. That says additional detail. It's providing additional detail about the government-wide level. So you sit there and you say, well, okay, I guess we kind of do that in commercial, and that we have what? We have subsidiaries, and those subsidiaries get consolidated up. But unlike you would see in corporate commercial accounting, where they might give you some of the information about the subsidiaries, but not all of it, in government, we will literally be able to tie the government-wide level to the fund level. We give you everything. We're able to tie those two together. And so we give you all of the fund level information, all of the consolidated government-wide information. That constitutes the basic Gasby reporting model that all state and local governments have to provide. Question on all that?
I had a quick question.
Yeah.
On your like, if you could just scroll down, like where you have the two like box things for proprietary funds.
Yeah.
You circled one of them. That's pointing to business activities, right?
The second lone box there.
Yeah.
So I circled the 5+1. So there's 6 funds that get under governmental activities. Right. Only one of the 2 proprietary funds, we'll see this in a while, it's called an enterprise fund, is reported under business type activities. Fiduciary funds are not reported at the government-wide level.
Oh,
they
okay.
are reported at the fund level. So these, you report them at the fund level, you don't report them at the government-wide level. And I'll explain a little bit more about that here in a couple of little whiles.
Okay, cool. Thank you.
Question? Okay, good. So with that, let's look at our first multiple choice question for tonight. Let's just take a quick look. Oh, sorry guys, before we do that, that whole little picture that I just drew down there is said in words right here. Okay. All that I just showed you down there is except the point about reconciliation. But I kind of said that. I didn't draw a picture of the reconciliation, but I did say in words, you have to be able to connect up. There's a literal reconciliation that has to be provided from the fund level to the government-wide level. Okay, and that'll be in F10. Okay, good. Now let's go ahead and take a quick look at this question. We'll talk about the reconciliation in F10, but let's go ahead and let's take a look at this question here. Okay, guys, I'll give you 5 more seconds on this. Shouldn't take us too long to do this one. Okay, good. Let's go ahead and take a look at this. And good, we got a good chunk of us getting this correct. The correct answer is A. You stop sharing those results to get them out of the way. Correct answer is A. And again, we gave the example. Here's, this special revenue, this gas tax that needs to be used for what? For road improvement, and we can only spend $1 million a year. So we set up a fund, okay, and that fund helps us to make sure that we spend the money on road improvement, and we get what I think I called it budgetary financial control. Yes, we get that budgetary financial control through our fund accounting. Okay, spend $1 million. That's the financial control per year, $1 million per year, whatever. On what? Road improvement. That's the legal restriction. Okay, question? All right, good. So let's go ahead and let's take a look at our second module here. Okay, we're going to start to talk about the fund structure and provide a little more detail to what we've already said, which is what? We have 3 categories of funds. We have the governmental fund category, proprietary fund category, fiduciary fund category, 3 categories. And within those 3 categories, we have 11 fund types. That was those 11 boxes that I wrote across. 5, why not put that again? 5 for the governmental, 2 for the proprietary, and 4 for the fiduciary funds give us 11 funds. Okay. Now, at this stage, the main takeaway from this section here is going to be what are the names of the funds and what categories do they fall in? So what is the categories? What are the categories? What are the names of the funds that fall in those categories? It's a better way to say that. And then what type of accounting do these funds use? Okay, now you take a look and you can see that we have first our governmental fund category, right? Okay, and they tell us that they use modified accrual basis of accounting and the current financial resources measurement focus. Now you look at that and you say, well, what the hell does that mean? Okay, well, let's just go ahead and put MA here for modified accrual accounting. And let's put over here accrual accounting. Okay, modified accrual accounting. So for accrual accounting, have you ever used accrual accounting? Have you ever used accrual accounting?
Yes.
Yes.
You absolutely have. There's no way you got to here getting ready to pass the CPA exam without knowing that you've been using accrual accounting. Good. So if you buy a piece of equipment, what journal entry do you make? Let's say you buy a fixed asset, a big tractor or something. What journal entry would you make? Say you pay $1,000 for it. That's a question.
Credit cash.
Okay, credit cash. If you can't figure anything else out, and I'm not saying that's the case here, get your credit down. Cash is involved, get your credit down. If you're doing a journal entry on the CPA exam and cash is involved, and you've seen me number journal entries, put in the cash. The cash is an easy point, and I always say free your mind, your ass will follow. It's amazing how you write down one part of a journal entry and then all of a sudden, boom, the other parts of the journal entry start to pop into your mind, right? Okay, so what would be the debit here?
Asset.
The asset.
Yeah, okay, equipment. I'll be a little more specific than asset, but yeah, it's an asset account. Good, for $1,000. Okay, and of course, as usual with my journal entries, I don't leave myself enough room. Right, debit the equipment, credit the cash. Good. Now for modified accrual, and let me go ahead and just point this up here so you know I'm not calling for my mama here. Okay, modified accrual accounting. Okay, if you purchase a piece of equipment, let's say, remember we said, hey, you got to spend money on road improvement. So let's say we buy a big piece of equipment that we're going to use to improve the roads. You ever seen one of those steamrollers? It's a big tractor and it's got a big round wheel in the front of it, and it's used to flatten the roadbed after they've laid the pavement. They keep driving that thing back and forth across to flatten it. You've probably seen that, right? Okay. All right. So let's say we buy a piece of equipment like that. Okay. Instead of debiting equipment, we'll still credit cash, but instead of debiting equipment, we will debit expenditure. And of course, we still got to credit cash. We're not going to mess you up that much, okay? To decrease cash, you still credit it in government accounting. But what we're doing here under modified accrual accounting is we're sitting here and we're debiting expenditure. It's literally going to hit the government's version, the governmental funds version of the income statement. It's called the statement of revenues, expenditures, and changes in fund balance. I think sometimes Gasby got paid by the word for the way they name some of these statements, but it's called the statement of revenues, expenditures, and changes in fund balance. It shows up as an expenditure on the income statement. Now that's odd, isn't it? Okay, that's not something you've ever done before if you haven't studied governmental accounting. Why do we do this? Because all we needed to demonstrate, our accounting objective was to see that we spent money with what? Within budgetary limits and within legal restrictions. So we can show, hey, we spent $1,000 and we spent it on road improvement, and we can show that by debiting expenditure. We can see what we spent the money on. Of course, we got to credit the cash. That's all we need to do. We don't have to keep track of this asset. We don't have, well, when I say we don't have to keep track of it, we're not going to let somebody drive away with the steamroller in the middle of the night and not know it. We keep track of it from an asset management standpoint, but from a standpoint of financial accounting, we don't have to carry it on our balance sheet. We don't have to depreciate it. We're not going to be calculating accumulated depreciation on that thing because we can show that we spent it. Now, just a peek forward. Because as good accrual accountants, you've been trained all your life. I'm not comfortable with this. Well, neither is Gasby. So Gasby says, yeah, at the fund level, to demonstrate that you spent the money in compliance with the budgetary constraint, the legal constriction, debit expenditure. At the government-wide level, we're going to make you report that equipment at the government-wide level. So you will start to have to understand the difference between modified accrual and accrual, but you're also going to have to understand that in the context of how a transaction would be reflected differently at the fund level versus the government-wide level. Government-wide level, we would do what you all told me to do. So when you get to government-wide, that's not that hard for you because it's following the accounting you've been studying now for a long, long time. It's at the fund level, the governmental fund level, that we have to start dealing with some weirdness like this. And your job in preparing for the CPA exam is going to be to get used to differences like this. But it starts to become, frankly, kind of fun as you look at some of these and you're like, oh, wait, governmental fund, I got to do this. Okay. So they say, forget everything you've ever known about accounting. Well, look, I just used journal entry to explain this to you. And it's kind of fun to understand, hey, a different way of reflecting a transaction depending on your accountability of your accounting objective. Okay, question? Okay, good. If there's no question on that, then we've answered what? We've answered the category. We've answered the type of accounting, modified accrual accounting. Now all we need to know is what are those 5 funds that fall into the governmental fund category, and the answer is provided by the mnemonic pronounced GRASP. I know there's no A in there. I know I'm a horrible speller, but we left the A out on purpose, okay? There is no A, but it is pronounced GRASP. And when I'm talking to folks and I'm trying to remember what are the governmental funds, I use the GRASP mnemonic: general fund, special revenue fund, debt service fund, capital project fund, permanent fund. 5 governmental funds. What type of accounting do they use? That's a question.
Modified accrual.
Modified accrual, current financial resources measurement focus. Beautiful. That right there answers 2, 3 of those, 15 to 20 multiple choice questions. They may say, which of the following funds would use modified accrual? And only one of the grasp can show up as that answer, right? They'd have to be, say, the capital project fund. Okay. Okay, good. Let's take a look at the 2 financial statements.
Question,
Yeah.
do we need to know what each of these funds are, or is it just good enough to know the name and that they're a governmental fund type and they use modified accrual accounting?
You need to understand the activities of those funds. What do they do? And I didn't say it here because we have a few pages later on in this chapter and in chapter 10 where we get more into the specifics of their activity. So that's a good question. We'll get more into that later. I don't want to deal with it now because then we're going to see it again later and you're going to say, well, why is he skipping that? And the answer there would be, well, I've already talked about it. I'd rather do it when we get to that material. So we'll talk more about the nature of what these funds do in a little while, just to sort of settle any concern you might have is, well, how complicated is that? For example, when we talk about the debt service fund, how do you service a debt? Just what would be your knee jerk on that? How do you service debt?
Pay it off?
Yeah, you pay principal and interest on debt. That's how you service debt. So when a government issues debt, we're going to see that they're going to set up a fund, and that fund's job will be to accumulate the resources to do what? Pay back the principal and interest on that. And so we'll understand the nature of that activity, and we'll take a look at the accounting around that. But it's nothing terribly complicated. But that's basically what's happening with these funds. Okay, but we'll get more into that.
Thank you.
Okay, good, sure, good question. Okay, now we come over and 2 financial statements. Now remember, I was showing you those columns. Okay, so what those columns represent is the financial statement for the general fund, the financial statement for the special revenue fund, debt service fund. Each column represented the financial statements of those funds. Those financial statements of those funds are self-balancing, meaning that they are what? You don't have a situation where you'd make a debit in the general fund and then you run over here and make the corresponding credit in the debt service fund. If you make a debit in the general fund, you make a credit in the general fund. So we have a balance sheet and an income statement, and they are self-contained. Now there could be inner transactions between the funds, but we'll have to make a full debit and credit journal entry reflecting the same transaction on each set of funds, assuming there was an interfund transaction. If the transaction was outsiders, it may only affect one fund, but if it's between the funds, you literally will have to make a debit and credit on this fund, a debit credit on that fund. Okay, so each one of those columns represented the financial statements of the government of the funds. And for the governmental funds, all GRASP, let's see, all governmental funds, which is given to us by GRASP, G-R-A-S-P-P. Okay, and I keep saying no A because one time a student got mad and said that I didn't talk about the A fund in GRASP at all. And I was like, there is no A, there's no A in GRASP, okay? All right, so GRSPP, and there's 2 financial statements, a balance sheet. Let me turn this to red. And something called a statement of revenues, expenditures, and changes in fund balance, which is like, not BS, John, which is like the IS, the income statement. Is there a question? Okay. Okay, good. Now, let me see if you remember your favorite song of all time. Is your favorite song of all time Assets? I don't know if you spell it like that. Assets equal liabilities plus stockholders' equity. Isn't that the lyrics to your favorite song, right? Assets equal liabilities plus stockholders' equity. Everyone remember that one? So if you have $100 of assets, then you must have $40. Then you could potentially have $40 of liabilities. And if you have $40 of liability, you must have $60 of stockholders' equity. Okay. Now, could you, and then when you report that, you'll say then that the liabilities plus stockholders' equity equals 100. Isn't that what we do in commercial? We show the assets, we list them out, $100. We show the liabilities, we list them out, $40. We show the stockholders' equity, we list it out, $60. And then we roll up the liabilities and the stockholders' equity to show that it balances on the balance sheet to the assets. Is that what we do? Have you ever heard of that one? That's a question.
Yes.
Okay, we're all on the same page with that?
Yes.
I know it seems like I'm asking, why is he asking us this? Because I get students that sometimes don't realize that on the balance sheet, we add up the liabilities and the stockholders' equity to show that it balances to the assets. Okay, good. Well, what Gasby says to us, okay, the Governmental Accounting Standards Board, that you have a required format for your balance sheet. And that required format will show current assets equals current liabilities plus fund balance. And then you will have to total those current liabilities and fund balance up, right? Okay, to show the total current liabilities and fund balance right there. Okay, so we follow that same format. Okay, now the only thing is it's current assets, not the only, couple things. It's current assets, current liabilities. Think about it for a second. When we purchased equipment, what did we do? We debited expenditure and credited cash. So if you acquire a long-term fixed asset, you debit expenditure. There is no non-current asset. Everything is current. Now, cash is current assets. So yeah, we have cash on the balance sheet and we credited cash when we spent it. Equipment is long-term in nature, so we debited expenditure. There are no non-current assets. There are no non-current liabilities on the governmental fund balance sheet. Thus, the term modified accrual accounting, current financial resources is telling you you only report current liabilities and current assets, okay? Now, they also have this, what I find annoying, but I can't stop Gasby from doing annoying things. They've come up with a new category here, a couple of new categories called Deferred Inflow and Deferred Outflow, okay? Now, Deferred Outflow is like prepaids, but not quite. Because if it was a true prepaid, a government can have a prepaid. A government can have a prepaid insurance. So if it was a true prepaid, it would be a current asset. But there are some things that are getting this close to being a prepaid, but it's not quite a prepaid. And so Gasby decided, you know what? let's have a separate category for those things and call them deferred outflow. And when you think of a prepaid, it is an outflow. It's an amount you're paying in advance, right? But there are some times that a government will pay an amount in advance and it's not quite good enough to be an asset, to be a current asset, a prepaid, but it's getting there. And so they decide to list it next to the assets. And we're going to talk more about these as we move on through the chapter here tonight. Okay. Now you also have something called deferred inflow. And deferred inflow is like unearned, that says unearned revenue, but not quite. If it was a true unearned revenue, it would be with the liabilities. Okay. There are some things that we get that are a little better than an unearned revenue. They are not quite a revenue yet. So we put them next to the liabilities, next to the unearned revenues that we actually have. We put them close to the liabilities, but they're not a liability. They are a deferred inflow. And when you think of unearned revenue, the money has come in. You can't show it on the income statement yet because you haven't earned it. So you show it on the balance sheet as a liability. And what Gasby is saying, well, some items are almost revenue. They're this close. They're ready to burst off of the balance sheet and go to the income statement, but not quite yet. They've got a little bit more to go. So we're going to show them as a deferred inflow, and we're going to show them next to the liabilities. Okay. We're going to get more into all of this. I know that's a little confusing right now. The main takeaway from this slide right now is what? Just remember some of the more basic things. Don't worry about these deferred inflow outflows right now. Just know that on the balance sheet, we have what? Current items only, right? Current assets, current liabilities. We report all of our current assets, and then that is going to equal up to what? Our current liabilities plus our fund balance. And then we gross that up so that someone can actually see that the balance sheet balances, and we report that bottom line. Now, the next question, thing that we need to take away here is, what is fund balance? Fund balance is like retained earnings. Okay, so if our assets are debits and our liabilities are credits, which that does not change in government. If you're thinking that assets are not debits and liabilities are not credits for government, remove that from your mind right now. Okay, because sometimes people will say things about government and they don't know what the hell they're talking about. So if you've heard someone say, well, you know, assets and debits and credits don't work the same. Yes, they do. Okay, we're going to have some times where they're going to be a little different, but that's for the budgetary accounts. For our real accounts, the debits and credits work exactly the same as you've known for a long, long time. Assets are debits, liabilities are credits. So if fund balance is like retained earnings, is it a debit or a credit? That's a question.
Credit?
Yeah. Debits equal credits, don't they? Okay. Assets equal liability, asset debit equals liability credit plus the fund balance credit. Okay. Now, of course, someone's saying, well, what if you have a negative retained earnings? Well, okay, then yeah, I guess it would be a debit balance in retained earnings. But if you have a, you know, negative retained earnings, but just assuming a positive fund balance, a positive retained earnings, it should be a credit, right? Hello?
Yes.
Okay. Okay, good. Now, flashcard, that required format for the balance sheet. Okay. And then let's come over and let's take a look at the statement of revenues, expenditures, and change in fund balance, which is like the income statement. Okay. And we have what? We have revenues. We have expenditures, okay? And then we have what? Other financing sources. and other financing uses. Okay. Now, other financing sources, where did it go? Other financing sources, squeeze in somewhere. Other financing sources are like non-operating revenue. So think about all the way back to F1 when we talked about the construction of the income statement, and we said what? We have operating items. Our operating items are our revenues and our expenses. And then we had non-operating items like non-operating revenue, non-operating expenses. Remember all that discussion? Okay. So the governmental fund version of the income statement, the statement of revenues, expenditures, and change in fund balance, is breaking out operating from non-operating, but they don't use those words. They say revenue minus expenses, and then they have the other financing sources, which are like non-operating revenues, and then we have other financing uses, which are like non-operating expenses. That says non-operating expenses, okay? And we'll talk more about the nature of things that constitute other financing sources and uses. This is just a way for you to sort of get these fixed in your mind as to what they are like. And then we have the net change in fund balance. Net change in fund balance is like net income. It's like net income, okay? Think about it. If you got rid of the potential for dividends, let's say there was no such thing as dividends, couldn't you call net income the change in retained earnings, right? Because retained earnings would go up by a gain, down by a loss, okay? Okay, now we have dividends, so we call net income, and then we consider the effect that dividends have on retained earnings separately. Net income should increase retained earnings, dividends should decrease retained earnings, right? And we show that all in the statement of retained earnings. In commercial, in government, we don't have to worry about dividends. We don't want to talk about income because we're not really here to turn a profit. There is no profit motive in government. So we call what's like net income, we call it change in fund balance. What is fund balance like? Fund balance is like retained earnings, right? Okay, good. If fund balance is like retained earnings, okay, you might want to open your mics for this exercise. If fund balance is like retained earnings and revenue increases retained earnings, then what does revenue do to fund balance?
Increases it.
Good. Revenue will increase my fund balance. Good. If fund balance is like retained earnings and expenses reduce retained earnings, what do expenditures do to fund balance?
Decrease it.
Decrease it. Good. Excellent. Okay. If fund balance is like retained earnings, okay, and non-operating revenue would do what? Increase retained earnings. Then what do other financing sources do to fund balance?
Increase it.
Increase it. Good. If fund balance is like retained earnings and non-operating expenses would decrease retained earnings, what do other financing uses, which are like non-operating expenses, do to fund balance?
Decrease it.
Decrease it. Good. Excellent. And I think that's the first time I've got through that exercise without screwing it up on one of them. Okay, good. Excellent. Very good. Okay. So flashcard that set up for the statement of revenues, expenditures, and changes in fund balance with the important analogies there and what they're like, and also make sure you are comfortable with how these different things affect fund balance. That is going to be something the examiners will expect you to know. Question? Okay, good. Okay, so notice what we're doing here, guys. We're just getting the names of the funds down, the type of accounting they use, and a feel for the structure of the financial reports. That's the 3 takeaways from this discussion right now here in F9, okay? All right, good. Let's take a look at our next category then, which is the proprietary funds. How many proprietary funds?
2.
2, good. We have what? We have our internal service fund, and we have our enterprise fund, and they give us a mnemonic for that, which is C, S-E, and you say, well, where's the other E? We have horrible spelling here, don't we? Okay, so we're not going for correct spelling. We're just going to put together a mnemonic that will help you remember the names of the funds and the type of accounting they use, okay? And so the type of accounting that is used by my 2 proprietary funds is full accrual accounting, economic resources measurement focus. Thank you, God. The accounting you've been using for a long time, you should use it for your proprietary funds. Now, just to kind of get straight the nature of what's going on in these funds, these are like businesses being operated by the government, okay? For example, the government city bus is really a business being run by the government, right? You do what? You drop the money in the, I don't know how they do it anymore. I don't know, maybe it's been a long time since I've taken a bus. I don't know. Do they make you wave a card or something? Whatever, you drop some change in the thing. When I was a kid, we had to drop 3 rocks in the thing, whatever, okay? And so what happens? That's the government running a business. They charge you, they give you a ride down the street, right? Okay. That sort of activity we're going to learn is counted for in an enterprise fund. Notice we have another category here, though. Very important that you know the other category, the internal service fund. The internal service fund, the customers of that business are not the citizens. It is the other funds. Do cities own vehicles? Yeah, the buses we talked about, fire trucks. Please don't let a police car be behind me when I'm coming home on a Friday night, right? Okay, whatever. Okay, these are all city-owned vehicles, and they need to be maintained, and they need to be maintained at a pretty high specification level because they're carrying citizens and they're emergency vehicles and whatnot. So we don't want to take them to the corner garage. We do what? We take them to a motor pool, a central garage, if you will, and that's where all the city's vehicles are worked on. Now, what they do is they charge the other fund, wherever that vehicle came from, they charge the other funds. So, for example, police cars, fire trucks are really general government type resources. And so probably the general fund will pay for the work that's done in the internal service fund for those city vehicles. So it's like a business. They'll charge the general fund for that work. They'll bill them. That billing will be a revenue. Of course, they'll have a receivable now. Meanwhile, we'll debit receivable, we'll credit revenue. Meanwhile, in the general fund, they're going to debit expenditures and credit accounts payable. And then, of course, eventually there'll be a transfer of cash that'll come out of the general fund and into the internal service fund. In the general fund, they'll debit the payable, they'll credit the cash, and in the internal service fund, they'll debit the cash and credit the receivable for that whole thing. But the takeaway right now is that what? The internal service fund provides service to the other governmental funds, okay? And it's done on a cost reimbursement basis, and it's other departments, other funds within the government, okay? Enterprise funds are set to account for acquisition that are intended to be more than 50% supported by user charges. So that's why you have to pay for water. They cannot maintain the water, the sewer, whatever, without you paying for that water. That's why they cut you off. If you don't pay the water bill, you're taking a shower, you're washing your hair, what the heck? Pay the bill. They turn it off on you if you don't pay the bill, right? You have this problem, I don't. You're washing your hair. I got soap in my eyes. Why? Because you didn't pay. Okay, so when something has to be supported by user charges, and by user charges, we mean we're charging, most of the money is paid for by those outside of the government enterprise fund. When most of the money is coming from entities inside the government internal service fund. Okay, but right now, all I need you to know is that there are two proprietary funds, which is what? The internal service fund, the S&C, and what? The enterprise fund, the E&C. What kind of accounting do they use? Full accrual account. Yep, that's all I need you to know right now. Good. Okay. All right. And then finally, we turn to, oh, sorry, I forgot their financial statements. Okay. Let's flashcard this here. The enterprise fund is used when we meet the criteria here, and they call it 3 criteria, and I see 2 criteria. Okay, so I'm not going to highlight the word 3 there because I see 2 criteria. The activity is financed by debt secured by a pledge of fee revenue. Okay, so what happens? Let's say I need to expand the water utility, and I'm running the water utility for this government, and I say, let's just issue bonds to improve the water. Okay, in San Francisco, for example, San Francisco Water District probably has a big capital expenditure coming up because the Hetch Hetchy water system, which is one of the best in the country, by the way, if you didn't know that, needs some upgrades. Okay, we're going to learn this in chapter 10, not together, I'll record this, but there's something called infrastructure assets. And one of the things that President Biden is talking about is getting money to upgrade water systems that need upgrading. And I can't believe it when I see people argue that that's not infrastructure. Yes, it is. How could that not be infrastructure? I mean, what kind of society can we have if you can't go up to a faucet and turn water and have water come out, for crying out loud? I mean, it's probably more important than roads. It is more important than roads. You got to have water coming to your, like the Roman aqueduct. I mean, this is things that have gone on for centuries now. Okay, you got to have water coming. That's infrastructure. Okay. Anyway, stop, John. So what happens? Let's say I need some money for that, and I'm not going to get the money I need from the federal government. So I say, I'm going to issue bonds for this. Okay, and the bondholders come up and say, okay, we'll buy the bonds, but we want some to know that we're going to get our money back from these bonds, the principal and interest. So I say, okay, I'll tell you what, I will pledge the revenue from these bonds, the revenue from the water, to pay the principal and interest on bonds. Would you buy that bond? They're gonna have to charge for the water, and people are gonna have to use water. So you got a pretty good backing of what gets paid to pay for those bonds. And so that would constitute then that the water utility, because it pays for all its costs through revenues, and if it's through debt, they've paid some amounts, but then that debt is backed by the revenues, then you have an enterprise fund. And then again, here, fees are adequate. Fees cover cost. And that's why I didn't see it as, 3 requirements. I saw it as 2, and that we could just charge fees and the fees will cover our costs. So maybe we don't have to do any sort of financing because we've got a longer term, bigger project, and then we'll match the service of that debt with the revenues that come in later on, like many corporations and whatnot do when they have certain situations. But in this case, they've pledged the revenue to pay for the principal and interest on those bonds. Okay, so if you have either of those 2, and the other thing to keep in mind, if you see a question on the exam that is indicating that revenues are going to be used to pay for the cost of an activity, revenue, the what? the revenue's backing the debt, or we're actually using the revenue, that generally constitutes what? An enterprise fund. Okay. Okay, good. Now let's take a look at the two financial statements. And again, well, this is a little misleading because it's actually 3 financial statements. And you're like, well, where's the third box? And I'm going to write it in. Okay. The proprietary funds, and it's only the proprietary funds, also prepare a statement of cash flows. And we're going to study that next time or when I record that. Only the proprietary funds prepare a statement of cash flows. Okay, so we actually have 3 financial statements. Statement of net position, which is like BS, is like the balance sheet. Now look, guys, if assets equal liabilities plus stockholders' equity, is it also possible that assets, is it mathematically certain, is probably the better way to say that, that assets minus liabilities will equal stockholders' equity? God,
Yes.
why can't I write that in order? Stockholders' equity, right? Right? We all know that. Okay. Well, that format of showing what as the bottom line here, the stockholders' equity, is the approach that they recommend. The format that they recommend. That is recommended format for the statement of net position, and frankly, what the examiners are going to expect you to see as almost required, okay, for the statement of net position, okay? Now, because we're on full accrual accounting, notice, guys, it's all assets, all liabilities. Now, different revenue recognition rules will apply to my proprietary funds because they're using full accrual accounting than would be applied to my governmental funds because they're using modified accrual. But we still list the deferred outflows and deferred inflows. We still list them with the assets, with the liabilities like we saw for the governmental funds. But then notice we take the difference approach, which is what? Assets minus liabilities equals, and we have this thing called net position, which is like retained earnings. And you stop. You don't add up the liabilities and the net position again to show that it ties to the assets. The bottom line thing that you're presenting is the net position. Thus, notice the difference in name. We don't call it a balance sheet. We call it a statement of net position, which is the thing that it ends up showing you at the end, right? Which is the difference between the assets and liabilities. Okay. Now, when we deal with the statement of revenues, expenditures, and change in fund balance, you can put somewhere up here that is like the income statement. Did I say change in fund balance? Excuse me. Statement of revenues, expenses, and changes in fund net position. And this should make you very comfortable. This is F1, guys, all over again. We have operating revenue, we have operating expenses, non-operating revenue, non-operating expenses. Difference is what? Not net income. We call it change in net position, but it's like net income. So revenue, since what? Since a net position is like retained earnings, revenues increase net position, expenses decrease net position, non-operating revenues increase net position, non-operating, excuse me, expenses decrease net position. And then we'll get into the statement of cash flows in F10. Okay. Okay, good. One more category of funds, and then we're going to take a break. Okay. Excuse me. So we have what? We have our fiduciary funds. Okay. How many of those? I think we said there are 4 fiduciary funds. There's the custodial fund, the investment trust fund, the private purpose trust fund, pension fund, and I don't know, other employee benefits. I mean, they could have just stopped at P and had this, pronounced KIP, but they wanted it to be KIP-PO. Okay, whatever. But there's 4 funds, okay? The custodial fund, investment trust fund, private purpose trust fund. Just remember pension, okay, for the mnemonic for those. So we know through this mnemonic, the 4 fiduciary funds, and then they use full accrual accounting, economic resources, measurement focus. Thank you, God. That's just like we've known for a long time, how to use full accrual accounting. Okay. What are the 2? And guys, again, only the proprietary funds prepare a statement of cash flow. So we're back to what? 2 financial statements. And the 2 financial statements are the balance sheet and the income statement. Okay. Now, when you look, notice that format is very, very similar to what we saw for the enterprise funds. The one difference is this is the required format. It was suggested, recommended for the proprietary funds. This format is required. Assets minus liabilities equal net position. When we get over to the statement of change in fiduciary net position, which is like, I should put the word like, the income statement, additions are like revenue, deductions are like expenses. What was it? Those people that talked this funny way back in the 80s or 90s, like, whoa, man. Okay, so it's like what? It's like the revenue, it's like expenses, and then the change in net position is like net income. You guys are probably too young to remember that. There was these people that they put the word like in front of everything. Okay, so it's like revenue, like expenses, right? And then the additions are like revenues, deductions are like expenses, your additions minus your deductions equal your change in net position, which is like your net income. Okay, so flashcard these formats for these statements too. I don't think I said that up here. Just note that only the statement of cash flows is only prepared by the proprietary funds. Okay, question? Okay, good. One more thing, and then we're going to go to the break here. But I thought this was pretty good down here because it essentially, where'd it go? There's something I thought was pretty good, but I don't know where it is now. Okay. Well, I guess it used to be pretty good and they took it away. Let me see if I can find that. Maybe it has to come down here. Yeah, here it is. Okay, I was going to get mad here for a minute. Right here, just come down here for a second. We'll come back to those other things. But I want you to make a flashcard out of this. Make a flashcard out of this. And I think this is a good flashcard because it reminds you of the mnemonic And then it tells you some of the key elements we looked at, which is what? Modified accrual, current financial resources, measurement focus, reminds you of the mnemonic. Nice little flashcard, right, for our governmental fund category. And then right here, governmental fund category, okay. And then for everything else, another flashcard right here, which gives you the full mnemonic, which is grasp, see. Look, guys, just remember one word. I mean, they want it to be kip, po, okay, but at some point, a mnemonic fails under its own weight, okay? So I would just remember see, kip, okay? You don't have to remember an O and an E for other employee, okay? See, kip. So grasp, see, kip. Make a flashcard out of that. You've got the mnemonic here, and you've got what? You've got the fact that it's economic resources, full accrual basis of accounting, and they remind you that we're talking about the proprietary funds and the fiduciary funds. Okay, so I think that's a pretty good little couple of flashcards, and then we'll come back after the break and we'll come back up and cover some of that stuff I passed over from here. Okay, question? All right, guys, let's take about 10 minutes and we'll come back and pick this up. I'll go ahead and pause. Somebody remind me to keep going when we get back. Okay, we'll take a quick break. Okay, guys, I want to go ahead and fire us back up again here so that we make some good headway here through chapter 9. And a couple of things here on these pages that we already know, I think, but for our current financial resources measurement focus, we do not, which is used by our governmental funds, our GRAS funds, we do not have fixed assets. We do not have long-term liabilities, current items only, right? When we get to our C-KIP, right? C-KIP, the proprietary funds and the fiduciary funds, then we are back to full accrual accounting. So we will have fixed assets, we will have non-current liabilities, okay? Now, when we talk about the income statement effect of modified accrual, again, used by our governmental funds, okay? We use a criteria to recognize revenue of measurable and available, okay? Measurable essentially means that they know the amount, and you say, well, how would a government not know the amount? Well, in the case of something called derived revenues, they have to wait for the return to be filed before they really know what the amount of revenue is, like income taxes, et cetera. So they put in that measurement point there to remind governmental accountants that they need to estimate what their revenue is going to be, even if the returns haven't been fully filed and whatnot. But they say it has to be measurable. So they have to have some mechanism to end up knowing what that revenue will be. And that mechanism generally is return information, tax returns, in income tax return, for example. What's more interesting to us at this point is available, okay? And available means that they have it or they will pretty soon. So they've already collected that revenue or they're going to collect it pretty soon, okay? And under modified accrual, available generally means within 60 days, okay? Now be careful, because I see a lot of people walk around saying, yeah, Gasby requires it to be collected within 60 days to be available. And that's not what Gasby says. Gasby says it needs to be available to finance debts of the current period. And many, many government entities would say, well, it's collectible within 60 days. So what happens? If I'm in a situation where I'm not going to collect that revenue within 60 days for my governmental funds, I cannot count it as revenue of the current year. That will actually be counted as a revenue of the next year, okay? So we will be using that 60-day criteria, and you'll see how that's going to work in a couple of questions. Okay, so you can go ahead and flashcard that, but I've got some more stuff that I'm supplemented the book here with to show you in a little while here to help bring some of that home to you. Okay, now when we talk about expenditures, generally expenditures are recognized when the fund liability is incurred, with some exceptions. Most notably is the situation with debt service. Okay, and we don't recognize our interest and our principal payments on interest as expenditures generally until they are paid. Okay, now why is this important, and why am I having you flashcard this? Well, a common exam trick or thing that they want you to know is they'll say City of Hayward issued $100,000 of bonds with a 3% interest rate, and the interest is due January 1st of each year. They issue the bonds on January 1st, 2021. How much interest should Hayward report at December 31st, 2021? And your instinct as a good accrual accountant is going to say, well, 1 million times 3%, what's that? I mean, what I say, 100,000 times 3% is what, $3,000? So I should accrue debit interest expense 3,000, credit interest payable 3,000 at the end of the year, being a good accrual accountant. No, the answer to that question would be what? 0, because that interest isn't due until what? January 1st of 2022 in that example. So at December 31st, 2021, you would not accrue any interest. We don't accrue interest in between interest payment dates. We take the interest expense at the time that the interest actually has to be paid. Okay, question? Okay, good. And when we're dealing with our CKIP funds, okay, full accrual accounting, revenue is recognized when earned, expense is recognized when incurred. Just use your full accrual accounting. I could ask you that same question that I just asked you for a proprietary fund, and the answer would be at December 31st, the entity should do what? Should debit interest expense and credit interest payable at December 31st, because we're using full accrual accounting, right? Question? Okay, good. Let's go. We are going to make a flashcard of that other stuff as I already asked you. And then let's go ahead and let's look at a couple multiple choice questions. Okay, guys, I'm going to give you 10 seconds here. This is not a real difficult question. If you're not trying this question, you're not really trying. Okay, I don't know what's happening if you don't answer a question like this with some sort of enthusiasm. I get the feeling you're not here. You're not paying attention, okay? And then I start wondering, why are you taking this class? Okay, because as I said at the beginning, you know, the governmental accounting is 15 points on the exam. I mean, there is no way to pass this far portion of the CPA exam without having this stuff down. And then you look at this stuff and it's pretty easy. I mean, 93% of us got it right. And if you tried it and you didn't get it right, maybe you didn't read the question carefully. But I'm more concerned with the fact that we've got, you know, some 6 to 7 individuals that didn't even bother to try it, which I say, well, what are you doing? Because it's not a hard question. The economic resources measurement focus and accrual basis of accounting would be most appropriate for which of the funds and what? The answer has to be what? One of the governmental funds must be listed there, because only the governmental funds use modified accrual current financial resources measurement focus. And then I look, and right out of the gate, they list the most famous of the governmental funds, the G in GRAS, the general fund. Should take you about 10 seconds to answer that question, okay? And by the way, on the CPA exam, you know, you build your passing score, you know, one question at a time, right? That's a positive point in the right direction towards your passing, okay? So let's go ahead and let's all kind of turn to the computer here, turn off the TV, and take a look here now at the next question, question 2.
For the first question, the answer was C, though.
Oh, okay. Maybe that's what happened. Maybe somebody didn't read the question carefully enough. Sorry about that. Then why did everybody pick A? Or did they?
Everybody picked C.
Oh, did they? Oh, okay. All right. Sorry, guys. All right. So maybe I should pay more attention. I looked at this and I got it inverse of what it was, which is they're saying which of the following would be using economic resources and full accrual. So it must be listed what? All governmental funds except one, right? So general fund is a governmental fund. The permanent fund is a governmental fund. Capital project fund is a governmental fund. So yeah, internal service fund. Okay, my bad. That does not excuse not trying to answer that question. So I'm sticking to my rant about that. But yeah, it is C. Sorry about that. Okay. All right, good. Thank you. So let's go ahead and let's take a look at this next one. Okay, let's go ahead and let's take a look at this one. And again, I'm a little frustrated by the fact that we've got 15 people. This means that there's 4 people that are not even trying to answer this question, which means they're taking a nap. And then I'm a little concerned. I mean, we got it 75%. I don't see why this wouldn't be 100%. So explain to me what I'm not explaining here, that we have said that the current financial resources measurement focus and a modified accrual basis of accounting is only used by one category of funds. That was the governmental funds. So it's yes, no, no. I mean, most of us got it right, but somebody want to tell me why this didn't end up being 100%? Somebody want to tell me why anyone would choose B?
Oh, I accidentally clicked on the wrong number. I should click on C.
Okay, well, that's okay. I mean, don't do that on the exam, but that's understandable here. Okay. Be careful on the exam that you click the right number, right choice. They don't have letters. But look, I mean, guys, you know, it's important to me that this class does well and passes the exam. You know, I would like to die and know that I put together a class that helped people pass the exam. And I feel like if you don't answer a question like this at all, or if you get it wrong, I feel like I'm failing in that desire. And if we were talking about calculating fully, you know, diluted versus primary earnings per share, then I say, well, hey, it takes folks time to digest that. This is pretty, you know, this is like, please God, may you get 50 questions like this on the exam. So you want to kind of follow what we're doing, pay attention to these, give these a try, you know, so that that's 15 effing points, man, on the exam. That's a lot of points towards passing. You only need a 75 to pass. And you're getting 15 points from stuff like this, okay? But all you got to do is kind of turn the brain on a little bit, you know, and you'll be in good shape for this, okay? All right, I'm going to stop with all that. Okay. So, but, you know, a good chunk of us got it right. Okay, let's take a look now at our next section here, and we're going to start to talking about accounting for the governmental funds. Our governmental funds are our general fund, special revenue fund, debt service fund, capital project fund, and the permanent fund, right? And we're going to start to get into budgetary accounting down here, okay? All of down here, we start to get into budgetary accounting, okay? Now I'm highlighting in yellow the budgetary accounts, okay? But we're also going to talk about activity, and I'm going to highlight that in green, and I'm going to write the word actual. So we're going to be talking about budgetary accounts, which they're saying budgetary, but encumbrance is also a budgetary account. And then we're going to talk about actual activity, okay? Now, this is the part of governmental accounting that causes CPA candidates to say, oh, it's all backwards and different. And they make much more out of this than is necessary. There is no reason to make this a big deal. So I want you to right now look for this for the fun, easy little thing it is. It's fun and it's easy. It is not a big deal, okay? So, but we're going to have to start learning something that we maybe haven't looked at before. But again, it's fun and it's easy, okay? So let's just take a look at this fun, easy stuff here, starting with the budgetary accounting discussion, okay? And our budgetary accounting I highlighted in yellow up there a couple minutes ago. And so let's just take a look and come all the way over to the next page, and we talk about budgetary accounting journal entries, okay? And they tell us the budgetary accounting entries are posted only twice during the year, twice during the year, once at the beginning of the year, and then again at the end of the year, okay? Now, you're going to have to flashcard and understand these entries, but they are not hard, okay? So let's first look at the beginning of the year entry right here, and let's flashcard it. And at the beginning of the year, this government will need to estimate what its revenues are. If it's estimating, does it know for sure?
No.
It's the beginning of the year and says, how much tax revenue do you think we're going to have this year? And they come up with an estimate. Okay. When they come up with that estimate, it's a budget. They budget $2 million of revenue. Okay. Now they have to use and flashcard and use the exact account names. They have to use the title estimated revenue, and they debit that estimated revenue at the beginning of the year. And in this case, they're debiting estimated revenue for $2 million. Now, this is where people say, well, it's all backwards. Okay. And that's a panicked response. Okay. The reason it's a debit, okay, and I'm going to put down here I think I'm going to put down here, let's see, it's going to fight me to the death, which it often does when I'm trying to write near the bottom of the page. Try it one more time, and then I'm going to try the top of the next page. Okay, there we go. Okay, so what I'm going to put here is a revenues ledger. Okay, and I'm going to go ahead and I'm going to put a debit for estimated revenue. I'm going to put a credit for actual revenue. And then I'm going to have a balance. Okay. So what did we do just now up there? We debited estimated revenue, didn't we? Right here. I'm not striking that out. I'm trying to underscore it. So we're going to bring that debit down. Okay. And we're going to go ahead and put in a $2 million debit. And when I put that $2 million debit in there, the balance is what? Not a trick question, 2 million, right? Okay. All right, good. Then, I don't know, this government has some fishing bills or something, some fishing licenses that they issue or something for cash. And let's say it's, you know, 50,000, I don't know. So they go ahead and they debit cash for 50,000. This is the actual now, right? They debit cash and they credit revenue for 50,000, just like you would in commercial in terms of debits and credits. Anyway, we're going to see that we have different revenue recognition rules, but once you've decided that you should record that revenue using the recognition rules, the debits and the credits to cash and to revenue are the same as commercial for the actual. And so what's the balance here now? What's the balance here now?
1,950,000.
Good. 1,950,000, right, is the balance in my revenue ledger after I've written in, I guess I could move that down a little bit, might look better. After I put in the 50,000, right? Okay, good. Let's say a little bit later, they issue, I don't know, how about 450,000 of licenses? Well, they will debit cash, 450,000. They will go ahead and credit revenue, right? This is our actuals being displayed in red here. 450,000. We go ahead, we put in that credit of 450,000 in here. And now what? We got 1,500,000 left to go. Is the balance?
Yes.
So the budgetary function here that's going on, remember, we want to make sure that we're having budgetary control, and we're achieving that here by seeing that what? Hey, we estimated 2 million, and maybe this is, January and February. So we're moving along. We've got 1.5 million left to go of revenues to collect. Okay, so you do that at the beginning of the year. You debit, and that's the part that people have trouble with. Meanwhile, it's fun and it's easy. You're just debiting a budgetary account, estimated revenues. So when the actual revenues come in, you can credit those. Okay, and it'll serve as a placeholder against your actuals. Okay, now what happens? Notice here now that they credit an account called appropriations. Okay, now when they credit that account called appropriations, okay, I want you to put down here approved spending. Approved spending. Okay, now with approved spending, what that means is the legislature. The legislature of a government, Congress, we don't have federal government accounting on the CPA exam, but Congress is the one that actually starts an appropriation bill. They're the ones that sit there and say, okay, this is what we're approving spending. Now, yes, it does go to the president for signature, but the Congress is Article 1 of the Constitution. So they're really seen as the group that starts things, even though there's a back and forth. For example, Biden proposes what he'd like to spend for infrastructure, but it's really up to the Congress to send a bill that says this is what they want. Now, of course, they know, when Trump was president, McConnell kept saying, I'm not going to send a bill up there if he's not going to sign it. That's what he meant, is he said, we'll start it, but we already know where the president stands on something. But the process really starts with the Congress, right? So they have an appropriation bill. And unless that appropriation bill is turned into an appropriation law, the government cannot spend any money. That's why a couple times they closed the government down here, because it wasn't that they didn't have money. They have the cash. They're either going to borrow it or take it from your check. So they have the cash, but they couldn't spend the pile of cash they have because they didn't have an appropriation law passed. Okay, so they can't spend any money until they do that. But once they do, now a government has the appropriation that they can spend. So it's approved spending. Now notice it's a credit. And it's a credit because what? Our actual expenditures, as we saw when we used the example for equipment, our actual expenditure will be a debit and we'll credit cash. So that credit will serve as a placeholder. And then as we actually spend money, we'll debit that, and we will be able to see how much left of our approved spending we have left, of our appropriation we have left after each spending. This is important because if a government were to overspend, the individuals, the people that are responsible for that overspending will be subject to, not the death penalty or anything like that, but would be subject to civil money penalties, personally liable for a penalty. So they need to be careful not to overspend. Okay. Now, in this particular case, this government, sat here and had a surplus. They had an amount that was left over, that was assumed to be left over. So they credited budgetary control, that is a surplus. Notice that budgetary control goes two ways. It could be a debit if the government has a deficit. Okay, now in the case of the federal government, they have a deficit every year to the tune of some $30 trillion now. And if you're trying to figure out who to blame for that, blame them all, because they all agreed to it year after year after year, and they've been doing that since the 1980s. Okay, so anytime you hear somebody trying to blame that deficit on one or the other, they all take their turn. Okay, now enough of that discussion. When a government has a deficit, it plans it. it writes it into the budget that they're going to spend more than they take in. It's not an accident. They do it on purpose, okay? And it depends on what they're trying to accomplish that they use to justify that they're doing that, but they do it on purpose. But once they get this appropriation amount, okay, they cannot spend more than that. Once they've set up that appropriation, they cannot spend more than that, and they will probably spend all of that. Okay? Question? You've got to know that entry. You've got to know that entry, but it's not hard. Debit the estimated revenue, credit the appropriation. If the debit is more than the credit to the appropriation, we got a surplus. We'll credit an account called budgetary control. Or if what? If this credit is more than the debit, the spending is more than the estimated revenue, we'll have a deficit and we will debit budgetary control. I don't understand what the big deal is. Question? Why everyone's freaked out about this? Okay. Now, let me ask you a question before we move to the end of the year entry. At the are these accounts related to income statement accounts or balance sheet accounts? Are we tracking income statement accounts here with this budgetary entry, or are we tracking balance sheet accounts?
Income statement accounts?
Revenue is an income statement account. The appropriation we're tracking against our expenditures, right? Which is an income statement account,
Yes.
right? Okay, good. At the end of the year, do you close your revenues and expenses?
Yes.
Yes, you do. So at the end of the year, you close your budgetary accounts. And you close them for whatever you set them up for at the beginning of the year, because they don't have any sort of dynamic changes. I mean, it could be that they might get an additional appropriation or something in the middle of the year, but for the most part, these estimated revenue, these appropriation accounts stand static the entire year as we track against our budget, right? So at the end of the year, we report them twice, beginning of the year, at the end of the year. At the end of the year, you simply reverse. Well, that's easy too. So at the end of the year, I'm going to debit the appropriation. If I had a surplus, I'll debit budgetary control, and I'll credit estimated revenue. If I had a deficit, then I'd have to do what? Credit budgetary control. That's it. 2 flashcards. 2 flashcards conquer what half of Facebook is saying is the hardest thing in the world. Okay?
I have a question.
Yeah.
I'm not trying to be nitpicky, but is there a reason that at the end of the year when you're closing it out, you don't use the word control after appropriations?
Yeah, there's a reason, because, you know, when Tom Cox put this information together, he always forgets to do that kind of shit. And I keep telling him, Tom, you didn't put control there. No, that's a good catch. There's absolutely no reason. All control means, Davi, in all seriousness, is it's saying that it's the GL level. Okay, because underneath appropriations, there would be subsidiary callouts that would cause a person to lose their mind as to exactly what they're appropriating the money for, down to pens. Okay, and you know, we're not dealing with that on the CPA exam. We're just dealing with the GL level, the big control account. So even though they may have appropriation of 1,950,000, down at the GL level, it's say, well, $1 million of that is for public safety, 50,000 of that is for park and recreation, and it'll roll up to the 1,950,000. So there is no reason, except that he forgot to put it. Just know that the word control does not constitute a budgetary control. It constitutes a control level, GL level account, and not a subsidiary account.
Okay, thank you.
Mm-hmm. Yeah. Yeah, that's confusing because we're talking about budgetary control, and then they start using the word control, and that's annoying. And unfortunately, the examiners, we're doing it here, even though we forgot to put it there, because when I say we, Becker, because the CPA exam does it, so we're having to do it just to get you used to that and hopefully have that question asked. Okay. Okay, let's look at the activity. Okay, and when we look at activity, we're going to start out talking about revenue. Now, when we look at revenue, okay, much of the government's revenue is non-exchange. Non-exchange means that the government, okay, receives revenue and you do not get anything back in return. Okay, at least not immediately. So what does that mean? You pay your property taxes, and when you pay your property taxes, you expect what? You expect to receive, police service, fire service, parks and recreation, but you don't sit there and go to your city government and say, excuse me, where's my fun and excitement in the park? Okay, you just expect the park to be there when you're ready to go ride your bike or whatever, right? Okay, so they call it non-exchange because you pay your tax, but you don't sit there and then immediately expect the government to jump and do something. That is different than if a government has an exchange revenue. You pay the government and you expect something back. For example, you pay the government for a city bus ride. What do you expect? You expect the bus to drive and be on time and get to where you're going, right? You pay your water bill. What do you expect? You expect when you turn the water, there's going to be some there, right? Okay. Those would be example of exchange revenue, but taxes are typically going to be considered non-exchange. Now, the book goes on a bit here, okay? And I'm going to go ahead and supplement with what they have here because I think it gets a little hard to capture what's going on from the way they've laid this information out. So what I've done is I've taken this information and I've put it into some slides that I think will be a little easier for us to digest. Okay, can you see that?
Yes.
Okay, so you see on the screen now a slide. I'm going to just go ahead and leave it. You can see it when it's not, even though it's not in slide mode, right? Okay, and the way we decide whether or not we should recognize a revenue, a non-exchange revenue, is by the category of non-exchange revenues. So these four that you see here are all non-exchange revenue, okay? Now, I have the type, derived, imposed, government mandated, even though I didn't say non-exchange, it is. These are all non-exchange. And then you've got voluntary non-exchange, okay? Now, let's take a look at these, okay? First, you have derived non-exchange revenue, okay? Examples: sales tax, income tax. In other words, the revenue, the tax that is paid is derived by some underlying transaction. So for sales tax, what's the underlying transaction? Not a trick question.
A purchase of something or a sale of something.
Yeah, you go and you buy something, you got to pay the sales tax on it, right? In most cases, right? You buy a new car, you got to pay the sales tax, right? Okay. All right. Income tax is what? The underlying is you're having income that you have to pay tax on, right? Okay. Now, what is the requirement in order to recognize this revenue? They categorize the requirements into time and eligibility. Now, for our derived non-exchange, and you can kind of peek down, it's going to be the same for the imposed non-exchange. We do not worry about eligibility. The government has decided it is eligible to collect sales tax. It is eligible to collect income tax. And if you don't agree with that, I'll see you in jail. okay? Or I'll see you when I take your property from you, okay? They're sitting there and they're saying, hey, you're going to pay this, okay? Don't think you're going to get away with not paying it, okay? Or if, you know, you go to a store and they say, oh, no sales tax. Well, that means they're going to pay the sales tax. Somebody's going to pay that sales tax. So the government doesn't worry if it's eligible, okay? So for a derived non-exchange like sales, the revenue recognition criteria is we can recognize that revenue when the underlying transaction takes place. So for sales tax, if the sale took place in 2020, what year's revenue would that be? Not a trick question.
2020.
2020, good. What if the sale took place in 2020, but the government doesn't collect that money until 2021?
2020.
Still 2020 because the underlying sale took place in 2020. Very good. That's all there is to it. Okay. All right, good. Question. Okay, so with that, let's look at this example. Okay, so what I have here is a situation where this government had sales in the first quarter of the year, and this gets a little confusing because first quarter in this example is going to be what? October, November, December, guys. That's the first quarter. Is a fiscal year assumed here that runs from October 1st to September 30th. See how that's working? Okay. So they had sales at 46,000. They give us the sales tax rate 2875, which look, won't be collected until the second quarter. So in this fact pattern, the presumption is that they collect the sales tax in the quarter after the sale. Okay, so that's why I'm putting NA here, because I don't care what they collected in the first quarter. That belongs to what? Sales that happened in the previous year. Okay, so notice that they go through this process here for the first 3 quarters, right? And notice that in each of the cases, the collection comes in the quarter after, right? Okay. Now, for my accrual recognition, notice that I do what? I take as my recognition as my sales, all the amounts for which the sale occurred in that first year, in that first fiscal year. And then all I did here for the fourth quarter was break it by month. Okay, so if you're trying to figure out, well, what's the revenue here, you add these amounts up, and for full accrual accounting, you get 6814. With me so far? The underlying sale took place in this year. Let's just put a year on here. Say these all happen in, well, fiscal, let's make it fiscal 2021. It all happened in fiscal year 2021. So I recognize revenue for accrual purposes for 2021. Notice that there's what? There's this remaining 1313 that I'm not going to collect until the next fiscal year, but it doesn't matter because the sale took place in what? In fiscal 2021. So for accrual purposes, I take that. Okay. Now, notice that for accrual purposes, I would have to make an adjustment at 9/30, the year end, to say that I have taxes receivable of 1313 and I have revenue of 1313. Now, sometimes students will say, well, how would they know that? Do they have a time machine? I mean, it comes in 9/30 and we don't know yet what's still left to maybe even be reported at September 30th because they're not telling me about that until October. But the government would probably issue its financial statements 3 to 6 months, maybe even 9 months after the fiscal year. So they would probably know the collection pattern before they have to issue the statements. But for statements dated 9/30, it would be correct that those were still in receivable status and they could take the revenue because the underlying transaction had happened in fiscal 2021. Question. Okay, good. Now, remember we said for modified accrual, you've got to look at the what? Measurable and available, we said. And we said that available means that it will be collected within 60 days of the balance sheet. Remember that? Okay. So notice that in this example, I had this 200 slip outside of that 60 days, right? You've got what? They collected 1113 in October. They didn't collect anything in November, and then 200 didn't get collected until December. So it went outside of the 60 days, right? So for that reason, notice that the revenue that I'm allowed to recognize under modified accrual is what? Is short of that 200, okay? So now when I make the adjusting entry at the end of the year, I still put as receivable the 1313. And again, I wouldn't be preparing my financial statements until later. And so I would know that, hey, there was 200 that fell outside the 60 days. I would take the revenue for the amounts that were collected within the 60 days. And I remember that account deferred inflow. I said, hey, it's not a liability, but it's not good enough to be a revenue yet. So we can't call it revenue. So we have a category where we put it next to the liabilities and we call it deferred inflow. Here you go. Classic example of something that ends up being deferred inflow. So we debit the taxes receivable for the full amount. And at the fund level, we would be reporting what? We would be reporting this as deferred inflow. At government-wide level, we would report it as revenue because even though we haven't talked about it yet, government-wide statements use full accrual accounting. And so you'd have two different reportings, one at the government-wide level, one at the fund level, and then we would have to reconcile that at the end of the year. It's the same concept as we did what? Debited equipment under full accrual, but debited expenditure under modified accrual. You do two different levels of accounting at the government-wide level and the fund level, and then again, you'd have to reconcile the difference between what you did under full accrual and modified accrual. Question? Okay, good. Now this, where'd my clicker go? This chart, okay, I'm just gonna jump this way. I don't need the clicker. This chart, okay, is a nice little summary now. Okay, so let's take a look. Derived non-exchange, sales tax, income taxes. We just worry about time. What's the time issue? We recognize the revenue when the underlying transaction takes place for full accrual accounting. But if we're dealing with modified accrual accounting, then we've got to worry and we've got to look to collection to see if it falls outside the 60 days. So you got to be careful with exam questions. You've got to see what level of reporting are they asking you about. If they're asking you about one of the funds, then check to make sure they're collecting that within the 60 days. If they're saying what would be recognized at the government-wide level, then you don't worry about the 60 days. As long as the underlying transaction took place during that year, you can take the revenue. Now we have this second category here called imposed non-exchange. Again, imposed non-exchange and derived non-exchange only worry about the time issue. Example of imposed is property taxes and fines. Property taxes, government says your house is worth $1 million and I'm going to tax you 1.5% of that value, 1.25% of that value. Send it in. What do you do? What do they do if you don't send it in? You got a house. You're supposed to pay the property tax. You don't pay the property tax. What do they do to you?
Threaten to take it away, take your house away?
threaten to take it, put a lien on it, and good luck selling that house until those property taxes are paid. Either you're going to pay it or the purchaser going to pay it, right? Okay, good. Okay, so they've got you, right? So you're going to pay that, okay? Now, what's the time requirement? What's the time requirement that says, well, when can the government recognize that imposed non-exchange like property taxes? And for property taxes, okay, for property taxes, we say when use may first begin. What the heck does that mean? Well, governments almost always send out the tax bill prior to it being due. And they sometimes will send it a year before it's due. So let's say they tell you you have to pay your property taxes by February 2022. Well, they're not going to wait until February 2022 to tell you that. They're going to tell you that in November 2021. They're going to send you that bill because they want to make sure you know you owe it and that you're going to pay it on time, right? So they send it in November, but it's not due until 2022. And they're saying we want that money in 2022 because they're going to use it to fund 2022 activities. So 2022, so use may begin in 2022 in that example, okay? Now, would there be any reason that you would send your taxes in early? Why would you send it in before February? Why would you send it in 2021? You got the bill, says it's not due until 2022, you send it in 2021. Why would you do that? Where's my tax people? Why would you do that?
Tax deduction in the year that you pay it.
You get a tax deduction in the year you pay it. So this government's getting money ahead of the time when they can actually use it. So what would happen under that scenario? They would go ahead when they mail out the tax bills, debit tax receivable. I'll just make it $1 million bucks. Why not? And they credit. This is in November. In this example, say November 20. What did I say? 2021. They debit tax receivable for 2021, 1 million. They credit deferred inflow. Why? Because they can't use that money yet. It's not quite a liability because it's almost a revenue. Once I get into 2022, it'll be revenue, but I'm not in 2022 yet. So it's not a liability really, but it's not yet a revenue. So we call it deferred inflow. And then if you send some in early, debit cash, say 500,000 gets collected. Debit cash 500,000, credit taxes receivable 500,000. This is, say, I'm just going to make this up, say December of 2021. Say December of 2021. Some money comes in, they just credit the receivable. And then finally, January 1st, 2022 comes. And now we're in 2022, use may begin. They will debit, and I'm going to abbreviate it, guys, DF, deferred inflow, I guess is a good abbreviation for that, for the full $1 million, and credit revenue for $1 million because what? Because use may begin. I'm now in 2022. With me so far? Now, this is the full accrual rule. This is what I would do at the government-wide level. All this I would do at government-wide level. Now, what happens? For modified accrual, I have to kind of sit back a little bit and I have to ask myself, will any of that $1 million fall outside of the 60 days of 2022? Because if it does, it's not 2022 revenue. So what happens? I can, at January 1st, 2022, I'll go ahead and I'll debit deferred inflow 500,000 That's 500,000 for that amount that I know I've collected. And then I'm going to wait to see how I collect the rest of that. And let's say I collect the rest of it, and I'm going to kind of push the logic here a little bit. Let's say I collect almost the rest of it at December 31st, 2022. Would I say I collect another 400,000? So I debit deferred inflow, 400,000, credit revenue, 400,000. I still got what? I still got 100,000 sitting in deferred inflow. Now let's say I go into January, and in January of now what? 2023, I collect 75,000. Well, I'll debit deferred inflow, 75,000. I'll credit revenue, 75,000. Now this is what? This is at the fund level because I'm using modified accrual accounting, and I'm using modified accrual accounting, and I'm still within 60 days of 2022. So that's still 2022 revenue. Now, I think you know where I'm going with this. Let's say that there's still 25,000. There's still 25,000 from my 2022 tax bill that I mailed way back in 2021. It was for 2022. I, still have 25,000 left to collect. We're in 2023 now, and I don't get that until the end of March. Well, now I've gone past the 60 days. So I will go ahead and debit for that remaining, and this is now, I'll have to write it over here, at 12/31/2020. Well, not 12, but what I say, 3 March 31, 2022. And I get that money finally. And so I go ahead and I'll still debit deferred inflow for 25,000. I credit revenue for 25,000, but that is revenue for what year? That gets reported as 2023 revenue. I can't count it as 2022 revenue because for modified accrual, I fell out of the 60-day window. So this is a long way of saying that when this use may first begin, again, the difference in the two examples, the sales tax when the underlying transaction took place and when use may begin, the only difference between full accrual and modified accrual was what? Was this notion of how long did it take me to collect, and any amounts that fall outside of 60 days go into that next year's coffer of revenues. Question? Okay, now they also talk about fines and penalties here. Okay, and fines and penalties when the government has a legally enforceable claim. So the government fines you, they leave a parking ticket on your car. What do you do? What do you do when the government leaves a parking ticket on your car besides cuss and say, God, turn around there? And then what do you do?
You pay it.
Pretty much you pay it, okay? But let's say you came up, there was a ticket on your car, and you got a picture of the meter with your car with the ticket, and the meter's got time left on it. What are you going to do? Well, I'm fighting this, okay? So what happens? The government gives you, say, 60 days. I don't know how long they give you to fight a parking ticket. It gives you 60 days to fight a parking ticket, right? So what happens? If you pay the ticket, then they assume they had a legally enforceable claim. They take the revenue. If you don't pay the ticket and the year ends and you're still in your due process cycle of 60 days, and they may not know this, but the time is coming where you're successfully going to win that case, they cannot take that revenue at that point in time because they do not have a legally enforceable claim. So they have to have a legal enforceable claim. Now, if the year ends and your 60 days is expired and they still haven't paid you, they're going to go ahead and book that. And now they're coming after you with billings and whatnot, right? Okay. Okay. Government mandated, all of these are non-exchange. Government mandated is when the higher level of government tells a lower level of government. The state tells the county, you have to clean this up. And the state has the right to tell the county that because somebody's got to control what happens with the environment of a state or whatever, right? And they say, here's the money to clean it up. Okay. Well, notice here, they tell us that when use may begin. Now, they also mention eligibility here. And the only reason they're mentioning eligibility here is because sometimes when the higher level of government tells the lower level of government what to do, the way they do it is they say, spend the money, show us that you spend the money, and then we'll reimburse you. If that's the case, then yes, there's eligibility, and the government would have to, go ahead and spend that money to be eligible to get that money. If the state gives them the money before they spend it and say, go clean this up, sometimes there's a difference between the state's fiscal year and the county's fiscal year. So the county's fiscal year starts January 1st. The state's fiscal year, most states' fiscal years start July 1st. And they give them the money and say, but you must spend it during the state's fiscal year. So when they give them that $1 million, say they give it to them in May, they have to debit cash, they credit deferred inflow because they can't start using that money until the state's fiscal year starts July 1st. Now, the instinct of the accountant is to say, well, okay, I have to allocate that. No. As soon as you enter into July, the state's fiscal year, take the whole $1 million as revenue. That's the point there. Don't feel like you have to allocate it. Well, let's see. Since I got it halfway through the year, close to halfway through the year, I can only take half that revenue as revenue of the county's year right now. No. As soon as you enter into the state's fiscal year, Gasby has told us to take all of that. And the reason they're comfortable doing that is generally these grants that come or this money that comes from the higher level of government mandating a lower level of government to do something, it's a pretty even amount that they receive each year. So there's no real revenue recognition distortion that's caused by just taking all of that once you enter the fiscal year of the higher level of government, even though a chunk of that money won't be spent until the lower level of government, the county's probably next fiscal year, because they're probably not going to sit in that whole $1 million in half a year. Then voluntary non-exchange, finally, this idea of eligibility has meaning to us, okay? And that for a voluntary government non-exchange, now the lower level of government applies for money. They say, look, please approve my project, HUD, and give me some money, HUD, and you approve my project. And when HUD looks at those projects, they take some, others they reject. So you really do have to be notified that you're eligible. That's the what? That's the eligibility requirement. And then they layer on top of that time. So if they tell you you're eligible, then you could go ahead and set up the grant receivable and take unearned revenue. Now it really is a liability because what? You have to wait until now you actually can start to use that money. Then it'll go from the unearned revenue to what? To the revenue. Okay. All right. So with that, that's a lot, I know. Okay, let's go ahead and look back for a second at the book now and see if we can make some sense of some of the things that are here. Okay, so we have what? We have, let me put it back into full screen. Okay, good. So what do we have? We have derived. We saw that, right? Okay. For example, sales tax. Okay. And we have what? We have imposed. And we have the example of fines or property taxes, right? For the fines, we have to wait until the government has what? A legally enforceable claim. Okay. I'm just showing you the parallel between what I've given you as the example and the textbook. I'm going to come back to that example in a second. Okay, and then we have what? Government mandated. Okay, government mandated transaction. This is where a higher level of government provides and mandates certain activities by another level of government. Okay, state versus county for environmental cleanup. Voluntary non-exchange represents instances where the government receives resources and does not provide equal value. Again, they apply for that money. I don't know what the hell they're trying to communicate with that lousy explanation, but the lower level of government applies for the money. Okay. Okay, good. Now you come over and we look to see that we have time requirements. Okay. Time requirements. Where is it? Somewhere they summarize this a little better than that. Okay, well, I guess we're going to have to do it this way. Time requirements applicable to all non-exchange, the derived, the imposed, the government mandated, the voluntary non-exchange. Okay. Eligibility requirements are applicable to what? The government mandated and the voluntary, but really the government mandated, the only time an eligibility requirement comes in really is if they tell them they have to spend the money to get reimbursed. I mean, it's not like they can sit there. It's not like, you know, the government has to sit there and say, oh, okay, I got this money from the higher level of government, but I'm not going to spend it on what they told me I have to spend it on. So eligibility really, or it's not like the county saying, hey, guess what? The state gave me some money and I'm not eligible for it. So it really doesn't have meaning unless it's a reimbursement. Hey, to be eligible, you have to spend the money, then we give you the money, right? And then the only one that really made sense for eligibility was the voluntary non-exchange where they actually applied for that money. Okay, but I think the best thing, guys, is that slide that I just showed you, not the example where I was writing in those examples, that slide that had all that blue in the different categories. Make that your flashcard for this. Okay. Okay. Any question on that? All right, couple things. Now, let's look at these journal entries here for property tax. Okay, now we are not dealing with revenue recognition in this example, really. We're assuming that use may begin and they've met their time requirement. Okay, so what's happening? We go ahead and we debit the taxes receivable gross, 1,800,000. We credit the revenue, but we have to consider, is there any amount that we deem to be uncollectible? And in this case, which would be a pretty high uncollectability rate, but let's just roll with it, it's 10%. So if that's the case, look what they do. They credit an allowance for the amount that they think they're not going to collect. And sort of how we were seeing for the pledges, remember the pledges in not-for-profit in F8, we reduce the revenue by the amount we think we're not going to collect. We don't take a bad debt expense like you would in commercial in this case. Notice they debit the taxes receivable current, they credit the allowance current, receivable is a current asset. All this is telling us right now is these folks are not late in paying their taxes. Okay, then we go down to the collection. They debit cash, they credit cash for the collection. Not a big deal, right? 1.458 was sent in. They debit the cash, they credit the tax receivable current. So at this point, if we mailed out bills for 1,800,000, and so far we've collected 1,458,000, that means, right, that there's 342,000 that has not yet been collected. Okay, and so what do? They decide to reclass that receivable from current. They credit the current to take it out of current and debit delinquent. That means these people are late. It is still a current asset. All we're saying is these people have been late in paying their taxes. And then since we decided to reclass the receivable, we go ahead and reclass the allowance. So we take that 180,000 that we had put into current, we debit allowance current to class it out of current, and we decide to put the whole 342 that's still outstanding into the allowance, and we put into the allowance delinquent. And so if you take 342 minus the 180 that we had already had up there in the allowance current, now we're simply putting it into the allowance delinquent, plus the 180s in there now, plus what? Plus the additional 162. And we're saying, hey, we're probably not going to collect that either now because these people are already late. And so we reduce the revenue by the amount we think we're not going to collect. Okay. Now, this has nothing to do with the revenue recognition criteria that we talked about. This is simply what I say it has nothing to do. The fact that you're not going to collect it means you're going to reduce your revenue, but it has nothing to do with those rules for derived, for imposed that we talked about earlier. This is just simply how do you deal with what? With an uncollectible amount of taxes receivable. It is important, guys, that you understand the logic behind these journal entries. So I'm going to ask you to go ahead and the correct account titles. So I'm going to ask you to flashcard the journal entries associated with this transaction. I guess you can flashcard the collection too. Question? Okay, good. Let's come over. And let's do something here. I want to, I'm thinking the best thing for us to do with the time we have left is talk about what we're going to do. And then I want to do one thing before we adjourn though. So I am going to pick up the discussion in a recording from here. Let's see. Where does it say measurable and available there? What page am I on here? I'm going to pick it up from here, I think. Okay, I'll talk from here. Go through the end of chapter 9 and into chapter 10. That'll be one lecture. And then I'm going to do the back half of chapter 10 as a second lecture. Unfortunately, I'm not going to be able to get that first piece of that to you until Tuesday. So look for it Tuesday because we don't have class on Tuesday. So I'll use the class time to record what would be the class time to record it. And so you'll have it Tuesday. And then the back half of chapter 10, stay tuned. I'll put some announcement as to how I'm going to get you that back half of chapter 10 or when I'm going to get it to you, but I'll have to do a recording for that. Question on that? I'm asking the university to keep this module open until, what do we say, the end of the beginning of the fall trimester? Is that what we had agreed to?
Thank you.
Yes.
Yes.
Okay, so these will still be available for you to look at. The discussion is just, I'll be talking to myself. And then on May 1st, we're going to meet from, we said from 9 to 1, right? And we'll do a final review.
Yes.
Okay, good. Now, in the short time we have left, I want to do one revenue recognition question, because I know that, you know, that was a lot thrown at you pretty quickly there. So what I want to do is just kind of go through together. I'm not going to do the poll. Go through together and holy Toledo. Okay, they go on and on with this lease stuff. And I want to, yeah, this is a good question to look at. Okay. Okay, good. So let's just take a look over here at this question 3. Okay. And the following information pertains to property taxes levied by Oak City for calendar year 1. Okay. And then they say, what should we report year 1 for net property tax revenue in the fund financial statements? Well, okay. Frankly, they should have told me what fund. It's a governmental fund. So there's something wrong with that question. It really should say, well, which fund? The governmental fund is what they meant. Okay. And let's take a look and see how we would answer this. So the following information pertains to the property tax levied by Oak City. So collections during year 1, should that be part of my revenue in my governmental funds?
Yes.
Okay, good. I collected it. So it's what? It's well within the 60 days, isn't it? Right? It's during the year still. I haven't even got outside the year yet. Okay. How about 100,000 expected collections during the first 60 days of year 2? Should I grab that?
Yes.
Okay, good. So we pick that up. Okay. How about expected collections during the balance of year 2?
No.
Past 60 days. No. How about amounts that slip all the way into year 3?
No.
No.
No. How about this 10,000 that's uncollectible? No, I reduced the revenue by the amount I'm not going to collect, right? Can we see that?
Yeah.
So the answer here is what? 600,000. Okay. Now, this question didn't ask this, but you might see a next question that says they're trying to report at the government-wide level. Now, if they're trying to report at the government-wide level, you know, what type of accounting should I be using? I'll tell you.
Full accrual.
Full accrual, good. We haven't really quite gotten into all that yet, but yeah, I should use full accrual, right? Okay, good. So for the government-wide level, I'm supposed to be using full accrual. Then how about this 500,000 that's going to be collected during year 1?
Yeah.
Okay. How about expected collection in the first 60 days?
Yes.
How about these other amounts that are being collected in later times?
Yes.
Still take them, good, because government-wide is not subject to that 60-day criteria, okay? So we would take what? 690, but even for full accrual, if you're not going to collect the revenue you reduce your revenue by the amount you're not going to collect. For a non-exchange transaction, just like a charitable donation is non-exchange, just like these taxes are non-exchange, you reduce the revenue by the amount you think you're not going to collect. And so the answer for government-wide would have been what? Would have been 690. Okay. Question? Okay, guys, that's a lot of good work. We're still trying to catch our tails here, but I will go through and do the recording on Tuesday. It will take me through chapter 9 and into chapter 10. And then that back part of chapter 10, I got to figure it out I'll have it done at least by Saturday, May 1st, when we'll be able to start to do the final review. And we'll do that from 9 to 1 on May 1st. And don't worry if the university closes it here in the next day or so. I don't think they will, but I'm going to send them an email here tonight or tomorrow asking them to leave it open. And they've been very cooperative to leave it open for you and we'll go to the start of the fall trimester. We'll do it that way throughout the summer. Okay.
One question, will you be recording the final review on May 1st?
Yeah, I'll record it. If you can't, it's not mandatory. None of that, we're done with the class. If you're somebody was just hanging out for fun, you wouldn't have to do another thing to get the grade, but turn in the paper. I will, what is the saying? I'll bust you out, whatever. I'm going to come to your house and get that statement from you, the write-up of I will hurt you. Your grade will suffer, is what I mean by that, if you don't turn that in. And if you've done none of the homework, I'd call and beg for mercy right now if I were you, okay? But as long as you made a reasonable attempt at the homework, you turn in the paper, you're done as far as your grade's concerned. What I'm doing now is trying to catch up for the fact that there's just too much material to cover in the time we have, frankly. I guess I could do it a little faster, but if I went much faster, I feel like there'd just be, people flying off the edge like a thing plowing through traffic and knocking everybody over with material. I just don't want to do it that way. So we're going to have to do some catch up with the recordings, but the recordings will be there. And then you can look at those at your pace for taking your exam. So those other times are not mandatory. I will record them, however, so that they will be available if you can't make it that session. And if I'm by myself during the session, I'll just talk to myself and record it. Wouldn't be the first time I talk to myself.
Well, for the final review are we going to use the same Zoom link that we use for class, or?
Yeah. Yes, please. Yeah, tune into the same Zoom link. Yep.
Okay, cool.
Yeah. Any other questions? Concerns? Okay, guys, hopefully this all was helpful. I'm sorry we couldn't get through everything, but I'll be supplementing it with those recordings, and keep me posted as to how you do on the exam. My job goal is to see the pass rates for GGU go up. So that's why I am on you to pass this exam, take this exam, pass this exam. And yeah, it's my job and I'm getting paid for, they don't base my pay on whether you pass or not, but that's kind of what they're hoping I can accomplish here. But more importantly, passing this exam is a game changer. Okay. I'm telling you, I don't know anybody who passed the exam and then said, oh, I had one person do that one time. She passed the exam and then she wasn't getting the opportunities she thought she should get from having passed the exam, and she blamed it on me and Becker and said, you guys told me and now I don't, and you're shit. And then like about a month later, she had to send me an email and apologize because she had been offered a position with KPMG. Okay, so other than that one person who later had to withdraw that statement, I don't know anyone who actually goes, passes the exams, and then turns around and says, yeah, that didn't help. Okay, so that's the real reason I want you to get through this thing, get it out of the way, pass the exam, and you're going to see it's going to take you where you want to go in many cases. Okay. All right, guys. Thanks. I will see you on the other side. All right. Good luck with everything. Keep me posted.
Thanks.
Have a good night.
Hey, everyone.
Thank you.
Bye.